Good morning. Thanks for joining in. How would you look at what to do in a scenario and what the messaging that you give to your clients? Because while the world may be looking like not falling apart but coming off quite rapidly, crude is coming equally rapidly off, and that's helping the sentiment out here.
Yeah, so we've seen a bit of a dichotomy between how world markets have been performing and the Indian markets, at least in the last few days. And I think largely that has to do with the macro picture, at least the domestic macro picture, the fact that crude has kind of fallen pretty dramatically. And that has got a very big impact in terms of how INR behaves, how CAD behaves. And so I think the FII flows have helped. My sense is that the FIIs are taking the call that US growth is going to be probably a little slower in 2019. It's not going to crash, it's not going to slow down very dramatically. And in that scenario, I would think that India will look good. Now that's a question mark. It's a question that we need to ask ourselves. Will it be a kind of a smooth landing or would it be a crash landing in the US? That is the key question that one needs to answer. So if it is going to be a kind of a slow pace of growth in the US next year, I think India will be a good place to put money in. That's the big dilemma that investors face, and right now I think that
tell people right now. Then I mean, so, you go with the thesis that it will be soft landing, and therefore go out and buy.
So my own take is that we've seen extraordinary monetary stimulus in the U.S. for a very long period of time, and there have been a lot of new instruments which have come in, like the QE, for instance. So we really don't know what the impact of that is going to be once that punch bowl is taken away, and what bubbles have kind of risen out there, and which one are going to burst, and how deep could be the potential recession out there. So we've been basically advocating, and this has been something which has been going on for a while. We've been saying that we need to be careful, focus on quality stocks, focus on stocks where earnings compression, even if there's a situation where bad global macro is going to impact earnings in India, you should look at sectors and stocks where earnings are not going to get impacted very much. There could be a P multiple compression. That is assumed. I mean, if you have a market coming off, there could be a P multiple compression. But if there's no material earnings compression or book value compression to accompany that, then you're fine. Then when the market revives and there's a potential for the P multiples to come back up, then I think those are the kind of stocks one should get into. Say, consumer staples, or those are the kind of stocks where the multiples will look very expensive as we speak, 50, 55 times forward. But those multiples can compress. I do not disagree on that particular aspect. But can earnings compress? I would dispute that. I don't think there's going to be kind of great compression on earnings. I think probably they could benefit from better margins, because if commodities come off, then you could see better margins for some of these companies. So, and these are companies which are, oligopolies in their businesses, and so to that extent, when the market goes back up higher, and it'll go back up higher at some point in time in the future, these companies can again trade at 50, 55 times forward. So you will get that CAGR in terms of earnings. So one should be looking at capital preservation, survivability of the businesses that you invest in as a key factor, in terms of strategy, how to position your portfolio.
You made a comment in your earlier answer about the divergence of the move in the US versus us over the last 7 days of trade and the way we've been moving. Most market consensus is that it's going to be global factors that are going to be driving the next leg up rather than domestic factors. We sort of are moving the other way around in terms of the overall market mood momentum. US trade war, once the 90-day period comes to an end, we still don't know what's going to come out of that. You've got the Fed rate hike that's already been built in now. But the markets there's no sign of recovery. There's already talks of a slightly more sluggish earnings picture out there. So how are we going to look at this now? I mean, are we going to stick to domestics? Are we going to go global, look at global in a bigger way? Because we've been ignoring those noises so far.
So,
while everyone thinks to believe that, global is going to be the next.
Yeah, I think the worry is more on the global side. So if you're asking me what stocks or what sectors to focus on, it'll be domestic stories which are high quality, where there is a fair bit of the business franchise are quality franchises, good managements, where these are companies with very good market shares in the respective businesses with good return ratios and stuff like that. So these are largely consumer oriented. It could be consumer financials, it could be consumer staples, it could be consumer discretionary. That is the area I would probably look at. There are obviously some market participants have been saying that there could be a potential capex recovery to play that capex recovery. I think one needs to focus a little bit more on the global picture and what impact that's going to have on the entire market. Maybe it's a little too early to play the capex recovery. Yes, there seems to be an incipient capex recovery, but maybe it's coming a little late in the cycle, so to speak. My sense is that you look at cement, look at a lot of industries, look at power. They are all trading at. These industries are at very low capacity utilization at this point in time, and it's a little too early for me to play that cycle at this point in time. So I would still stick to the high PE multiple consumer place, play for safety, play for capital preservation, because I want to be there at the other end of the valley. I think we'll go through a valley. We need to be there at the other end of the valley with your fair bit of capital intact, is the way I would look at it. Okay.
It's going to be important to see now with what's happening to the currency as well and the impact of that to the currency specific sectors. And we've been talking a lot about IT over the last few days and how technically most of those larger IT names have been perched or probably even broken down below some of their key moving averages. Yeah. So, what happens now to IT as a pocket, Girish? Because that's going to be also in focus. We've been seeing a lot of pain in the larger names.
Yeah, so I think if you look at on a quarter-to-date basis, IT has underperformed Nifty in a fairly significant way. I think it's a factor of two things. One is how INR has behaved. It went down to as low as 74, 75, and now it's closer to a 70 or maybe even below 70. So that has an impact on earnings. The other is obviously the view on how US growth is going to pan out. Already there are issues with some interest rate sensitive sectors in the US, the auto sector, the housing sector. So there are a little bit of, and also the inverted yield curve. There could be an issue with growth in the US, but one needs to look at what happens to the banking sector in the US, because the inverted yield curve means that there could be pressure on net interest margins for the US banks, because typically you borrow short and lend long. So, and what is the consequence from a spending perspective from a US banks for the IT service sector going into 2009? So these are the worry factors which are probably impacting the kind of underperformance that one has seen in IT vis-a-vis the broader market, the narrow markets of Nifty and Sensex. So I think that's what's led to the underperformance. So there is two aspects to it: the core business, which I think is probably going to be under pressure, which I've been saying that for a while, and probably we could potentially see a 0 or a negative growth in FY21. And I don't think FY20 is going to be better than FY19. The general street view seems to be that FY20 is going to be better than FY19. I think we could be slightly slower from a growth standpoint in FY20 versus FY19 from a dollar revenue growth perspective.
Wow, and we're going to probe this point further. Did I hear Girish Pai say 0 to negative growth in FY21? The reason I said we'll do this in a bit, because what could also impact IT companies, and we'll ask Girish Pai about that, is what Accenture has done this morning. Marginal, but some revision upwards. So Girish, we'll just come back to you. Let's just go across to our research team to talk about that very aspect and what did Accenture do in the quarter, and with regards to his guidance ahead. Also talk about some of the other stocks and news. Agam Vakil and Nikki are here with us. Agam, let's start off with you. I presume Accenture would be top of your mind?
Well, yeah. So, it doesn't really directly have a bearing on the markets, but it does show us an indication of how this particular very large company has done in markets such as Europe and America. And based on that, we could perhaps draw some sort of conclusion as to what we can expect in the third quarter of this financial year for the Indian companies. So, starting off with your sequential growth for Accenture, it's around 4.9%. And again, when it comes to its EPS, that's higher than what the Bloomberg estimates were. So because of the fact that there is a little bit of a beat as against expectations on both the top line as well as profitability, well, that bodes well for perhaps the prospects of Indian companies in the third quarter. Going into a little more detail, while Accenture has, increased its lower end of the guidance, that may not have as much implications as much as the kind of growth that they've seen in some very key markets. So let's talk about North America, that has seen growth of around 4.3% sequentially, and Europe has seen 8.8% growth sequentially. Now, we all know that it is essentially support from Europe that is coming through for a lot of Indian companies. So given the fact that we've seen a near 9% growth, that could bode well for some of your larger names out there. Growth markets, on the other hand, have remained flat, and by growth markets, I'm assuming in this case it's largely emerging markets. But considering we've seen good growth in North America as well as Europe, that's a positive. We've also seen an uptick in financial services, and this is a trend that's been playing out for the previous 3 quarters, for that matter, 3 or 4 quarters, and it's not something that's out of the blue either. So that also bodes well. So we'll be watching out for the kind of sentimental impact Accenture earnings have on Indian IT companies.
If they do, let's wait and watch. Nikki, what about the other stocks in news?
I'm going to start off with Dr. Reddy's, a negative development coming in for the company, where Acquisitive and Indigo said that it's going to be, has asked the US Supreme Court to reconsider the petition with regards to the Subexon case, which was earlier granted in the favor of the company. Coal India is expected to be in focus. The interim dividend comes at 7.25 per share, implying a dividend yield of 3%. Separately, FE report also suggested that the NCLT has approved the insolvency process against a subsidiary of the company, a negative development for Coal India clearly. NHPC, which said that the buyback offer will start off from Jan 1. Earlier, the ex-date was November 30. The offer has been a little delayed from what the exchanges gather. And also, NHPC separately in the filing has said that the HP power station has completely shut, will be shut for 3 months on account of repair and maintenance activity. That's would have some kind of impact on the production numbers of the company. India Bull Real Estate separately, it has inked back to divest 50% stake when office properties in Gurugram for a consideration of more than 450 odd crore. We're looking at CARE rating out there, where there is a bulk deal. PubRai has sold in more than 2.5% equity in the company after the SEBI notice for conduct of proceeding. These are basically related to the rating that CARE has assigned with regards to INFS. And HT Media, do keep an eye out on this one. The company is going to be buying in 25% stake in Next Media Works. That's the promoter stake for 45 odd crore consideration. Separately, it's going to be acquiring a 26% stake, which will trigger in an open offer. Now, this price is 27, which is at higher premium, given that Next Media Works has already been rallying past 7 to 8 sessions in trade now. So clearly, one counter that we need to keep an eye out on. PVR, where the board is going to be meeting up today for considering various fundraising options.
Lots of stocks to monitor. Thanks a lot for that, Nikki, as well as Agam. We'll talk about Airtel and some of the others too, but Girish, just one quick point since we're continuing with IT. Some of the mid-cap IT valuations have come off, or at least the perceived valuations have come off. You wouldn't be bullish on any of the product companies either? And by the way, any impact that Accenture's numbers have on the sentiment today?
Yeah, I think some of the stuff that Accenture said on the banking and financial services sector is going to be important for the Indian companies, because the Indian companies have got a fairly large exposure to the BFSI space. Some companies have 30-35% exposure to BFSI. So it has had 2 successive quarters of very poor growth on a YOY basis. I think the quarter that has just gone by, they've delivered just 1% growth. They're saying the next quarter also the growth is going to be fairly tepid. They're talking about a rebound in growth from the BFSI sector in the second half of their fiscal, that is. Now, the commentary that's coming out of Accenture is a little worrisome, because we've just had a situation where the Indian companies, Infosys and TCS, actually come out in the last couple of quarters saying that most of the worries on the BFSI are behind them. So I don't know, there could be some kind of worry developing on the BFSI space again when it comes to the IT services sector. That's something I would probably kind of watch out for. The other one interesting question that was asked on the call yesterday for Accenture is, if we do see a downturn in the US, then how are things going to be for you? And it gave a reply which I thought was very counterintuitive, in the sense that it does a lot of discretionary work. 60% of the work it does is what's called new. And it said that is not going to get impacted. It is the legacy work which is going to get impacted, which is typically the run the business work. I would dispute that. I think typically discretionary work is what gets cut more in a downturn. So those are the worries that are there. I would worry about the BFSI commentary that the company is given. Otherwise, I would be a little negative on the Indian mid-cap IT services place. I don't track the product companies. I think mid-cap companies have had their own set of problems. In the last quarter, they've had execution problems in the sense that Hexaware and Persistent Systems, because of lack of talent, they weren't able to execute projects, which is a worrisome factor because you have an H-1B visa regime which is undergoing change, which to me looks like could be a negative for Indian IT services firms because it's going to be focused more on giving visas to the US corporates. And Indian IT services firms typically give salaries between $75,000 to $85,000. The US firms like Facebook and Yahoo and those pay typically between $130,000 to $150,000. So my sense is more of the visa are going to go to the US firms, which could mean that the talent shortage problem is actually going to aggravate going into 2019, which will probably impact the smaller companies a lot more than the larger companies. So I would be definitely worried about the mid-cap companies. Yes, they've come off quite a bit from the top, but I would definitely worry. See, the other is the breadth of capabilities. That is something that one needs to look at when you look at fulfilling demand. The larger companies have a far larger breadth of capabilities to address the opportunity.
The PSU banking space and the government now further recapitalizing 41,000 crores. They've dispensed already 42,000 crores. So total tally this year will be around somewhere closer to 83,000 crores, helping at least a few of those banks under the PCA to come out of PCA. Does this work well in terms of making sure that the engine keeps running?
So it's good for the economy, but if you're talking from an investment perspective, this is more like it's a trading bet, and I'm not structurally positive on the PSU banks because I think there are governance issues out there which need to be sorted out. And even if some of the bigger banks, if I were to be positive on something, I would be positive on SBI. But my issue there is that somewhere down the road, some of the other weaker PSU banks are going to be merged with SBI, and we'll again see a recurrence of some of these problems again. So that is, I would, unless the corporate governance issue is sorted out, which can only happen if government stake comes down from 51% plus downwards, I don't see a structural play in PSU banks. I would still concentrate my money on the private sector, corporate banks as well as retail banks and certain NBFCs.
Okay, interesting. Watch out for the large private banks. That's an interesting thought too. Just amongst the stocks in news, Girish, today, amongst many others, PVR. I think there's a board meet as well, maybe some raising funds, etc., etc. Just looking at the data, the last 4 or 5 years, it's consistently given positive returns despite the advent of Netflix, etc. What do you do now with the PVR?
So there are two stocks out there, PVR and Inox Leisure, and we are positive on both from an absolute return perspective, though the returns for PVR could be slightly lower compared to Inox Leisure. But obviously it's a leader in the film exhibition space. It's an oligopoly which is probably which is going to strengthen going forward. We have a 4-player market which holds about 70% of the screens, multiplex screens in the country, and the sense I'm getting is that more and more mall operators want either an Inox or a PVR to run their the theaters within their malls, not so much a Cinepolis or a Carnival. So I would think over the next 5 to 10 years, the stranglehold of Inox and PVR is only going to improve going forward. And I think the valuation from a consumer discretionary standpoint, I would think that they're reasonably cheap. These are even now, while the stock is kind of bounced about 40-45% from the bottom. There was a bottom created when this whole food-related, controversy kind of came up. I think it's bounced back up, but still I think it's going at a fairly decent multiple compared to some of the other consumer discretionary stocks. And I think this is a business which can compound at low teen levels. And my sense is that the EBITDA margins can expand a little bit further because the higher margin food and beverage business as well as the advertising business will continue to grow at a faster pace than the ticket business, the box office business. So it's a good play, but between the two, I would prefer an Inox Leisure versus a PVR because I think the upside is much more for an Inox Leisure. Yes, it's a small cap stock. Both are kind of small cap stocks from the current definition of how SEBI defines companies. But PVR is closer to $1 billion. The other is closer to a $300 million number. So that's the way it is.
Girish Pai, before we thank you, you guys initiated coverage on the liquor companies very recently, I believe 4 or 5 days ago. Quick thoughts here, about a minute. We're very close to market open. Do you like any of
so within the consumer space, we think that these are two companies where you could probably see high single-digit volume growth for a fair bit of time. Premiumization is going to lead to margin expansion. We're talking about margins expanding by something like 400 basis points between FY18 and FY21, which is going to drive earnings growth of maybe 20-25% for each of these companies on a CAGR basis, which potentially could be the best kind of earnings coming out of a consumer stocks at this point in time if you look at the entire basket. So not cheap, but we think that these are a very good place on the consumer side. So we've initiated both on United Spirits as well as on UB with a buy with a 20-25% kind of an upside. I think these are good stocks to own.
Well, to watch out fundamentally, then sticking to the two large players, which is United Spirits and United Breweries, is Nirmal Bang Securities. Girish, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time. A standout for me today. Your thesis on FY21 for the IT companies. We'll wait and watch what happens there.